And then I'm able to essentially get a house for very little money down. The tools that I use as an investor are this. Hey guys, Derek here. Thanks for visiting my YouTube channel. You're here for a couple of different reasons. One, we're here to talk about personal finance, business, real estate investing, or perhaps you want to watch my videos about Rivian and the electric truck revolution that's happening right now. Most likely you're here today because the video that we're shooting and talking about is how to use tools that investors use when they acquire different properties. Thanks for watching the video, and let's get started. I have acquired millions of dollars worth of real estate since 2015, and I've done it all by myself. I really have not had people helping me or coaching me. I've just gone through the school of hard knocks and learned how to invest, and I've also learned how to repair the properties on my own. I utilized YouTube as a tool to help me, and I was able to learn a lot of stuff over the years. I cut my fingers, I got dirty, and today I'm able to kind of look back and utilize tools that are a little bit more helpful, and I'm able to harness those. And now I try to get contractors to go into the properties so I don't really have to go in there. When I started in 2015, I started by investing in single family properties, which, as you know from watching my other videos, I like to purchase a house and then every 1 to 2 years get a new primary home and utilize what I call bank hacking. And bank hacking is where basically you have to put 3 to 5% down as far as a down payment to qualify for a mortgage. And then I'm able to essentially get a house for very little money down. It's not no money down, but it's very little. Versus buying an investment property, you have to put 20 or maybe even 30% down. So that's my little hack on how to get properties every couple of years and keep upgrading. But that's not what we're here to talk about today. The tools that I use as an investor are this, and it's very simple and you can download them as far as apps. But I like to shop, and sometimes I utilize my friends who do wholesaling, but that's a different story. I usually use HomeSnap, Zillow, Crexi, LoopNet, Trulia, Facebook, even that website called Craigslist. Yeah, sometimes I'll use that too. And I will actually look at deals and I will evaluate the deals to see if it's a property that I want to invest in. Let's take a look at the calculator and see what things I look at when I'm investing in the property to qualify if it's going to be a good property for me or not.
This is our financial summary page, and then this is the second page, which is the financial analysis. I typically work out of the financial summary page, and the main items that I pay attention to are the items that are in yellow. So anything that's in yellow is basically anything that I will update. And then scroll down just a little bit further, and these items will automatically be generated for us. So you'll see that our cash required for whatever deal is $31,000. Let's go ahead and play with this calculator just a little bit. Let's pretend like we're looking at a property that has a purchase price of $250,000. For simplicity, I typically keep this the same, but if you're buying a house that already has equity built in, hooray for you. But typically the prices that I'm looking at and the properties I'm looking at don't have any extra equity built in. And you can change, if you're getting a loan, you can change the interest rate, the percentage down payment, as well as the loan terms. So if you're looking at a 30-year, that's 360 months. You can manipulate this. Let's say today's rate happens to be 6.25% for the mortgage, and you're going to do a 30% down payment on this property. And that's being amortized over 30 years. And we've done our research. We looked up in the different softwares what we can get for rent, or perhaps the house is already rented that you're looking to buy, and you know that rental value is $1,650 per month. So immediately we can jump up here, and everything in green is going to give you all of the formulas that are already built out. Now, I didn't create these. I just recreated them and made them a little bit easier to see. So majority of things I do is I fill this out, I fill out the mortgage calculator, and then I'll update these. So if you know that you have a special vacancy rate that you look for, oftentimes, something high would be like 10% vacancy rate. But, if you know the property is 3% vacant, you need to put that value in there. I would also suggest for your maintenance reserve, you put something in there. And again, these are monthly. Your management fee, some places, depending on how difficult it is for the management company to work with, they might charge you 10%. Or, if you're doing it yourself, you're gonna have 0%, but you always wanna put something in here. I typically will keep this around 8 to 10%, assuming worst case scenario where I have to pay a property manager to manage that property for me. And then it's really important to know what your taxes are. So I typically will see taxes as an annual value. I take those values and I divide it by 12 to get myself a monthly tax price. And then insurance, they'll give you an annual quote as well. And I would take that and divide that by 12 as well to get your insurance on a monthly basis. Now, if there's a homeowners association, if it happens to be, $35 a month or $100, I mean, gosh, depending on where you are, it could be, $1,500 a month, depending on where you are. So keep that in mind. A lot of people will overlook that. And then if you are paying the electricity, or if you're paying the fuel, or you're paying any additional items here, you want to include those in. This adds up all the items from each one of these expenses. It's also important to keep track of your trash or your supplies or your janitor or lawn service. I pay around $50 or $60 for each property because I want to make sure that the lawns are all mowed on my properties so that they look good. And I think that's really important to keep the rents as high as possible. I try to keep those properties maintained so that they always are bringing in the best tenants for those properties. Now you can continue coming down here. What is your rental income increase? Are you going to increase year over year? Are you increasing taxes? Of course, taxes are always going to adjust. Utilities, your expenses, are your miscellaneous expenses going to increase? If so, how much? And this is important because the financial analysis sheet gives you kind of an extrapolation over the future years. So you're not just seeing this year, you'll be able to see the future years as well. The appreciation, closing costs, are you paying closing costs? If not, then, that's great. If you're paying, 2.5% on each side, this actually rounds up. Or if you're paying 0%, that's fantastic. If you're able to get a deal where you don't have to pay anything down, that's probably the best place to be. Then you're gonna see your closing costs go to 0. For me, realistically, I'm paying something. And I'm typically paying 3% on the buy and 3% on the sell side. I myself am not a realtor. So to acquire this property, for whatever the scenario is, we're assuming how much down payment? We're assuming 30% down payment. Don't forget you have closing costs. And I'm making this sheet available so you can see all the formulas and kind of trace them back where they're all coming from. But on this one, we'd have to have $85,500 down to purchase this property with $250,000 purchase price and a rental income of $1,650. Now, the important stuff that I really like to look at is the summary. Now, I've kind of broken these items down, and these are the items I really look at. I look at the cap rate, the cash on cash return. I also like to see my net operating income over the year. As well, for me, knowing what the annual cash flow is really important. It's just something that I really look to. And then understanding what your debt service coverage ratio is, that's really important as well to you, and lenders might be looking at that too. So what is a cap rate? So I've broken this down. I made comments here, and ultimately you're going to look at this area down here. But to identify this, I've kind of created a cheat sheet for myself, so I always remember this. Identifying a cap rate, you want to start up here. So we're looking at this annual operating income minus your operating expenses, and that's annually, equals your net operating income. So your income minus your expenses is your net operating income. Take that down here. So your income minus your expenses, which we just saw is your net operating income, dividing that by your purchase price or the market value of the home. Depending on when you're looking, if you're looking to buy now, you're going to be looking at the purchase price. If you already own the property and you're trying to calculate the cap rate, this is the market value. So it's the net operating income divided by the purchase price or the market value. Typically, I like to see this number around 8%. And that's just me. And of course, all of these items we look at, the higher the numbers, the better. So just always keep that in mind when you're looking at this Excel sheet. The cash on cash return, I kind of made myself a breakdown up here, and that's just so I can remember what I'm looking at when I come down here. So in the annual operating income minus the total operating expense, or the annual operating expense, same thing, is your net operating income. So we learned that from the cap rate right above. But when we come down here, the annual cash flow divided by the down payment. So if you're kind of like wondering what this is, you can click on this and the formulas are actually displayed in the financial analysis sheet. So if you ever question what that is, you can trace that back. So let's go ahead and do that now, just for fun keeping. So we're looking at C57 over here. So we click here. 57, where's C57? All the way down here. So it shows the cash on cash is negative 2.8%. Guys, if you're buying something negative 2.8%, you might want to run really fast in the other direction. To calculate the cash on cash, you're looking at C37 dividing by C45 on the other page. So we're taking a look at the annual cash flow. That's how much money annually you're going to be generating each year. And we're dividing that by C45. And C45 is right down here, the amount of money out of pocket. So you're taking a look at the amount annually that you're going to get cash flow dividing by the down payment. and that's looked at -2.5%. And that's just one method for investors to take a look at how much the return on investment is going to be. If you're negative, that actually means you're losing money. So again, run as fast as you can in the other direction. Another thing I mentioned I like to look at is the net operating income per year. So how much am I going to make more or less each year? 10,500. I try to get that as high as possible. And then our annual cash flow. Annually, we're losing money annually. So that's probably not a good number to have. Let's take a look at the other page on how we calculate the annual cash flow. So the annual cash flow is the net operating income, which we've gone over a couple times here, subtracting the mortgage expense. That gives you your annual cash flow. So if you have any questions there, you can always click back in those cells and kind of track back. Just one click and you can kind of track back the formulas that are inserted in there. And another one that I actually started looking at recently is the debt service coverage ratio. And let me break this down what this actually means. So you can kind of take a look at my notes here, but if you're at 100%, basically the cost of the property, so monthly, is going to be offset by the income monthly. And you're not just looking at the monthly mortgage payment and saying, you know, the monthly income is covering the mortgage payment. You're actually looking at the cost of the expenses of the actual unit itself or apartment building itself. So you want to make sure that it's covering its complete basis. And if we want to research what this means, we can look at the other page. We're going to look at C35, dividing it by C16. So we come over here, we look at C35, that's your net operating income, and we're going to divide the net operating income by C16, and that is right here, your annual payment. So your net operating income dividing by your annual payment is going to get you a certain percentage or a certain ratio. And if it's 100% or below, you're not covering your expenses. Now, if it's 100% or above, like 101 or 102 or even 125%, that's good. That means that basically the income you have from this property is being covered and you don't have to worry about it. You're actually free and clear. And your numbers up above will also show those too. So I like to find properties that are 125%, and this plays into your debt to income ratio. So if you're using your personal credit score to qualify for a mortgage, let's say you're buying a single family house and it's your 7th one or 8th one or even 2nd one really, the bank looks at your debt to income and they evaluate how strong you are as an individual and whether they should lend money to you or not. And once you've been able to achieve 125% for each property, then each loan that you take out or each new property that you get a loan for, it's not going to hurt or go against your credit score. Also filmed a video about debt to income ratio and why that matters, and a couple of tips and tricks on how to basically be able to keep purchasing properties. Because if you're not evaluating and watching out for your debt to income ratio, then you're not going to be able to continue purchasing properties. So understanding what that is really important. Overall, I think that's a quick summary of this sheet. Again, I'll make it available to you down below. And if you have questions, feel free to reach out to me, and you're going to want to make a copy of this calculator.